Hey folks, Freyman CPA here, Greg Freyman. Just wanted to quickly put together a video for a concept I thought would be really useful for everybody out there. There's a lot of misunderstanding about how depreciation works and what that component really means for people's tax returns, whether that's their business tax return or whether that's their residential rental properties and so on. in in the gist, okay, so when you buy something that has value in asset, it tends to go down in value, and that's what we call depreciation. So for tax purposes, we can actually say that we have a couple of different methods of depreciating assets. Okay, and typically we go by what's called as MACRS depreciation, modified accelerated cost recovery system. Okay, try to say that quickly 5 times. I'm sure you'll have trouble doing it. And without getting into too many specifics, I think the most important thing for people to understand is that when you're buying this asset, you get to choose how you're going to depreciate it. And again, you don't always need to buy the asset, right? You could be financing the asset as well, and you can also depreciate that asset. But the IRS has, and by the way, states also have their own rules as to how you can claim this depreciation. It is not as simple as like, I'm just going to pick 5 years, or I think this property is really 10 years worth of life. No, it has to fall into a very prescribed type of asset class. So if it's an HVAC system you're buying for your rental, or if it's a computer, or if it's your vehicle, it will fall under a very specific internal revenue code or state tax code, and it will be deemed a certain asset, and you'll have to basically abide by the rules of that asset's useful life and depreciation method. You have some advantages when it comes to electing what type of depreciation you'd like to declare. And for example, for federal tax purposes, you can declare Section 179 deduction and expense the whole thing out in one shot or part of it. But there's certain rules and parameters you first have to fall under. And those rules and parameters will be that you have profit, that you don't have a certain amount of assets that you're deducting. And then there's state differences. So federal versus state tax law, whereas federal, you can do a large amount, whereas state has a fraction of that amount. Then there's bonus depreciation. Then there's prescribed depreciation under MACRS. So there's options, all right? So that's what I want you to understand, is that there's always options. I've had clients come to me looking at me and saying, I didn't know that my accountant didn't fully write off my business truck that I use exclusively for business. It's a huge Volvo, and the truck was just taken over the prescribed 5 years. It cost me an extra $10,000 worth of taxes when we could have written the whole thing off. So that's what I'm trying to help out with here. I want people to understand that, first of all, when you're buying the asset, whether it's your business, whether it's you personally, and you're using it for business, you can depreciate that asset, and it is up to you, the taxpayer, the client, to elect how you're going to deduct it. As long as you're doing it properly and you understand the various complexities. You don't have to understand the various complexities, because your professional, if you're working with a professional, should be really helping you with that in a simplified manner and giving you just your basic options the way we do. So I say to my clients, well, you bought that Volvo. I'm not just going to write it off for 5 years. I'm not just going to fully expense it, because it's not my asset, right? I want to make sure that you understand what you're getting into when you're going to be declaring this deduction. And my job is to present to you your options and what you can do and what you cannot do, right? And why is this important? Well, because sometimes when you place an asset into service and you're going to write it off, sometimes it doesn't make sense to be very aggressive, and it will have tax implications. And that's what I'm here today to talk to you about. So I want you to think of it this way. Depreciation really means, do I want more tax now? Do I want less tax later? Do I want less tax now? Do I want more tax later? Okay, that's very confusing, right? I'll say it again. Do I want more tax now? Do I want less tax later? Do I want less tax now? Do I want more tax later? That's what you're really choosing to do with the vehicle or asset, what have you. Why? Well, because when you're writing off a vehicle, for example, vehicle, I'm going to use vehicle, okay? Let's say you bought a vehicle for $25,000. Now, let's say we're going to write it off in 1 year. We're going to write this vehicle off, and we're going to get a deduction. So on our books, as taxpayers, this vehicle now has a tax basis of $0. Zero. It's worth zero now because you just wrote it off, even though it's still retaining value, and it might retain value for the next 5 years, but you wrote it off. So for tax purposes, this vehicle in your hands is worth zero. Now, what happens 2 years down the road if you're trading that vehicle in, or you're selling it and you get something of value in exchange, right? You either get a new vehicle or you get cash because you're selling it. Well, you just got a gain. So what happens with the gain? The gain is taxed, right? So now do you see what I'm saying? So this is, let's say 2021 or 2022, and you wrote it off. So less tax now. But in 2024, you sold it and you got $15,000 for it. Now you have a gain. That means more tax later. Now do you see what I'm saying? So depreciation is really just smoke and mirrors. It's tax deferral. It's not necessarily a tax shelter. It's a tax shelter, but it's not actually like doing away with the tax, because you're gonna have to pay for it when you get something of value for it in the future. To some degree, you're kind of equalizing because things do go down in value, but sometimes they don't. For example, real estate. Real estate is one of those things where when you depreciate a rental property, you can depreciate it down to zero, but that thing only went up in value. It's not like a vehicle, right? And that's why they have this thing called depreciation recapture. I'm not going to go into how depreciation recapture works because that's just going to make things even more complicated. So we had a client, and this is really one of my classic examples, where he bought a Volvo truck, and no, it's not the same guy that came to me and had that other accountant. This was our own brand new client. They got a truck, they got a Volvo. And so what happened was, this was like their first year in business, a trucking company. And this Volvo was like $60,000. Okay, now this $60,000 is a lot of money, right? So, but he wasn't like fully invested yet into the business. He was not completely super profitable just yet. He was profitable, but it wasn't like a full year in business. So what would happen, right? What's the outcome? So remember I said that there's different ways to depreciate this asset. So you can take it over 5 years, 5-year depreciation, or what we call RX, or prescribed depreciation. That's just MACRS, Modified Accelerated Cost Recovery System, is by default, right? So by default, the IRS has a special asset class. It says here, your asset falls into this category. You can take it over 5 years. And then there's rates, right? So the first year, it's like, let's say 11% write-off. The next year is like 20, 32, and then it drops down, whatever. But at the end of the 5 years, you're gonna write it off in its entirety, right? Whether that's 5,000 in year one, whether that's 15,000 in year two, whether that's 25,000. At the end of the 5-year life, that thing is going to be written off and it's going to be zero one way or another. Or you can do something like accelerated cost recovery system, like Section 179, or bonus depreciation if it's within the right year while these things are. And you can literally say, well, I want to just Section 179 $25,000, or I want to Section 179 the whole thing, as long as you're eligible and you're within the parameters. Bonus is all or nothing, so the whole 60,000 would have to be there. Okay, you don't get to elect bits and pieces. So those are some basic options, and I presented those options to my client. I said, listen, you guys, if we write off this whole vehicle right now, okay, it's going to mean that you're going to get a refund of $3,500, tax refund. But if we take it over the prescribed time, okay, RX, it will mean you're going to owe $5,500. Well, you're going to say to yourself, well, why in the world would I take? Why in the world would I do RX? You know, when I RX equals tax due. Well, why in the world would I do something like that to myself, where I'm going to actually owe minus $5,000 instead of getting a refund for Well, that's simple, because in this year, as a taxpayer, you might be in the 12% tax bracket. Next year, since you're going to be more profitable and going into the future, you might be in the 22% tax bracket and then in the 24% tax bracket, and then you're doing really great because you're really taking home in the 32% tax bracket, or maybe the tax law changes in 2025, and now we're looking at some crazy new tax rate, 50%. Whoa, who would have thought, right? Well, that's what happened in 2017. Same conversation. So your tax deductions become more powerful in the years to come as your rates go up or there's a change in tax law, right? So in 2017 going into 2018, we had clients run out and buy vehicles on December 31st because their deductions were worth more in 2017 because the tax rates were higher until the tax reform came around in 2018 and the tax rates dropped. So if they were going to buy the vehicle in January, February anyway, so it was worth for them to then get into a brand new vehicle already by the end of the year because they were going to do it anyway. And placing it into service the prior year meant that their tax break would be 24% versus 22 in the next year just by waiting. Not even their rates haven't changed. It's just change in tax law. Change in tax law from 2017 to 2018. In this case right here that I'm going to highlight, this is just business growth. This is just the person. So a lot of the times it'll come down to the outlook of the client. What's their future outlook look like? And they have to understand the whole less tax now versus more tax later, or more tax now versus less tax later. They have to understand this concept and they have to really make this decision. All I can really say is without this depreciation, if we don't max it out, you're looking at this much due and you're gonna owe that this much due or this much refund if we max out or we start playing around with numbers with the different depreciation modules, different depreciation declarations that we can make, right? So we have those options, but sometimes it just has to be presented that way. And guess what this client did with the Volvo truck? They decided to spread it out over the next 5 years because it's in their outlook that they're going to be more profitable, and only they could know that. I have no idea. I can only say, well, I know the tax rates are going to go up after the tax reform is over, which is 2025. That we know, but maybe you won't hold on to it. Or maybe you trade in your vehicle very regularly. So why max it out now when you don't need all that deduction and you're just going to get value for it and cause taxes later when you might be at a higher rate? So that's the very important concept with depreciation that people need to understand. One, it decreases the value of the asset. So in summary, it'll decrease the value of the asset. So if you do get rid of it soon thereafter in some form or manner, it will trigger tax in the future, right? It will also create a situation where you won't have more deductions in the future, right? Because if you already wrote off the whole truck this year, what's going to happen next year? You basically have nothing to write off. You'll have gas, you'll have maintenance, this and that, but you won't have that large value anymore. So if you're in a lower bracket this year and all of a sudden next year you're doing much better and you're a higher bracket, you just cost yourself 10%. And that can really add up, right? I mean, 10% of $60,000 is quite a bit of chunk of change for tax liability, right? That's $6,000 right there. So I saved you $6,000 by just waiting, okay? And the rest is just like bits and pieces, but the idea is the same. You're going to recoup the cost of the vehicle as long as it's being used for business at 100%, assuming, right? It's used exclusively for business. You're going to recoup this cost one way or the other. It just becomes, when is it more efficient for you to do so? And it's not always clear-cut case. Like, yeah, let's just max it out. Well, hold on. Before you max it out, do you really need all those deductions? Maybe maybe your tax liability is like nothing this year because you didn't make any money. You know, why would you create a loss, you know, by expensing the whole thing out? So you just started your business and you're making profit. You haven't made profit yet and you're going to write off the truck? For what? You don't have any income to write off against. Save it for the next 5 years. Take whatever minimum you can this year as you have to, but don't take everything all in 1 year. All right, that's it from now from Freyman CPA. I hope this really helps out people that are learning about tax depreciation out there and want to have a good informed discussion with their tax professional. Remember, the tax professional should do their best to advise you as to the ramifications of how depreciation works on a very basic level. You don't have to get into the nitty gritties of all the various types of depreciation. Just get to know that it is at the end of the day your election to make, and you are the one that's in control, saying, well, I want to write it off now because maybe I won't be in business in the next 2 years and I need all these deductions now, or what have you. So that's it for today. Let us know if you have any questions. Again, thank you for being our loyal viewers and followers. We really appreciate each and every single one of our now 100 subscribers. Thank you guys. All right, anything else, you let us know. We'll talk soon. Bye.